This is Taking Stock on Bloomberg. I'm Pim Fox. Natural gas prices, they've collapsed. So what's an investor to do? Is there some untapped value in the natural gas patch? Let's find out. Let's bring in Nick Pope of Dahlman, expert in natural gas. Appreciate you coming in, Nick. And tell us, how bad does it have to get in natural gas for people to finally go, okay, no more, I'm shutting down the field? What's going on?
Well, I think it's interesting. There's two phenomena that you're dealing with. There's the nearer term phenomenon, which you see, producers, really looking at what it takes for them to shut in production, which is a very different, it's a very different thing from the longer term view, which is whether or not you want to drill more wells. And so I think what you're seeing right now is we're getting to the point where you're starting to see a lot of the marginal producers out there in the U.S. are getting to the point where it's going to cost them money to continue to produce the gas.
So the idea is just stop doing it.
That's just to continue producing. I mean, there's tens of thousands of wells out there that are producing right now that just are ongoing production every day. And on top of that, you have 800, 900 rigs that are actively drilling new wells to kind of make up for the depletion that we're seeing in wells.
All right, so you got that. Now you've got the demand side, which is just not there.
Well, I mean, it's interesting that actually looking at it, you have the industrial demand side of natural gas is about a third of natural gas demand. And I think you've seen two of the bigger pieces, metals manufacturing, and you're starting to see maybe an uptick. I think steel utilization in the U.S. is seeing a slight uptick from kind of the trough levels, 50% to maybe 60%, I think, in steel utilization. And I think on the chemical side, I think you're seeing some similar, like using maybe ethylene as kind of a proxy for chemical demand. You're starting to see that utilization in the U.S. probably dipped down to like low 60s, I think, on a percentage basis, and now we're pushing up towards 60 to 70% on utilization. So I mean, there is some like recovery there.
It's alive. There's something alive there.
But the big piece of natural gas demand is still it's home heating, it's electric demand, and those haven't been hit necessarily as hard as the industrial demand side has.
All right. So does that lead us to the idea that, well, $3 per million BTU, is it sustainable, or are we going to go higher? Where are we going to be?
Well, I think it's interesting. You got a lot of questions from investors, really looking at kind of that near-term price and kind of looking at like how to play, the expectation that that's not really a sustainable price. I think that's kind of the the general sentiment out there. But when you look at it, is you look at the futures markets, you look at some of what is priced into some of the E&P stocks, and you see that there's a much higher gas price kind of reflected in those future prices. And so there already is built into a lot of the markets an expectation of a recovery from that $3 level, because it's like there is some localized issues with natural gas where it's the near-term supply-demand is off. But the longer-term correction is in place, and that we've seen 60% of the rigs we are running drilling for natural gas have stopped drilling.
All right, so let's talk about some of the stocks, because I know that one of them today actually reported, one of them that you follow, McMoran.
Right.
What were their results, and what does that tell you about? Well, they're kind of an interesting model because you're saying they're pretty risky.
Right.
These guys are pure E&P players.
Right, they are. I mean, it's one of these things where McMoran, you don't see a lot of like pure exploration companies left in the E&P space. A lot of the companies really focus a lot more on the production side. But you see McMoran really focuses on really higher risk, higher reward wells in the Gulf of Mexico. And so they reported their earnings this morning. And, it was a really noisy quarter. There's a lot of issues in there with hurricanes and some recovery, items that they have coming in and out of the earnings. But I mean, fundamentally, production looked good for them. Costs were down, and, operating costs were down, and, capital expenditures were down as well from, I guess, where expectations would have been. So it actually ended up being a pretty positive quarter.
That helps their cash balance, too.
Absolutely. So, but really the reason why people invest in McMoran, though, is not generally for, like, the near-term earnings. They like drilling these big wells. There's a lot of spice in the stock. And so you look at, like, what's drilling right now. And there's a couple big wells that really have investors' attention right now. One is called Blueberry Hill, which is, it's drilling it's drilling on the shelf in the Gulf of Mexico in shallow waters. And it's a big prospect. And they've already identified a certain amount of like prospectivity in the well. So they've already identified that there's some success in this well, and so they're going to continue to drill that. There's some mechanical issues in the well that they're going to get.
Because they're doing it laterally too, right?
Yeah. So there's some minor issues. It's stuff that it's not major. It's stuff that happens in a big deep well like this. But the other well that they're drilling is called Davy Jones, and that one is actually a little more interesting because they're actually drilling up a concept that if you look at it, they're trying to open up an entire trend in the Gulf of Mexico, something that nobody's really ever produced before. So it's really kind of high concept geology that's going on here.
All right, and you got a buy rating on the stock right now.
I do.
All right, we're going to continue the conversation. We've got more on natural gas with Nick Pope of Dahlman Rose. Not every natural gas company is working the new shale plays, as we just talked about. We're going to take a look at some of these conventional producers, maybe for some unconventional profits. This is Taking Stock on Bloomberg. This is Taking Stock on Bloomberg. I'm Pim Fox. My guest is Nick Pope of Dahlman Rose, expert in natural gas and energy. Nick, let's just wind up on McMoran exploration. You got a $9 price target on the stock. The stock closing today, $5.77. You'd say there are some near-term catalysts to be aware of. What are they?
Well, I mean, I think we started talking about it. The Davy Jones well, they're trying to open up an entire trend in the Gulf of Mexico. And really, nobody's ever really produced anything or had any success in drilling to some of the formations where they're drilling. And it's something where the individual well itself is a big prospect. It's a nice prospect. But it has much broader implications for a large area of the Gulf of Mexico if they can have success with it and prove up kind of the concept that they're working on. And so I think that's what people find really compelling right now. And so it's one of these things where you look at kind of the valuations and where they are right now, and you're getting a lot of the optionality on some of these drilling and some of the big potential that you see in some of these wells for very reasonable valuations right now. And so that's when you see a high risk, a company that's going after high risk prospects like McMoran is. I mean, you want to make sure you have some support in the downside from the cash flows, like we talked about earlier, that we saw today. I mean, there is a fair amount of cash flow support for this company. It's not trading at unreasonable valuations right now.
Okay, but this is a bet on this Gulf of Mexico trend, as you say, as you describe it.
And, and it's something that you'll see in the next 3 months. You'll probably hear some results on it, and so I think it'll probably garner.
Well, we're going to have you back much sooner than 3 months to follow up, and we want to know. Of course, we want to know what happens before they actually. Well, we'll see if you tell us that. All right, now turn your attention to one that is working in the shale plays. This is southwestern Arkansas is the target focus here. Fayetteville share. What about Southwestern? With gas prices so low, why do this?
Well, I mean, it's something where you look at like kind of the rates of return that they're seeing on their wells, which, as you mentioned, is highly focused in the Fayetteville Shale, which is in Arkansas. And the rates of return they're seeing there are still very solid at even current gas prices. And when you look kind of out of the strip, they're still able to get a reasonable return. That's how good the wells are.
Even with the depletion rate so quick, right? 80%, right?
That's right. And so what you're seeing is they're not really actually outspending cash flow right now that they're bringing in, even at the current gas prices, and they're very aggressively drilling. So they're seeing a high level of production growth really within their cash flows, which considering how fast they're growing, kind of is a great indication of like how great the rates of return are they're seeing in the Fayetteville Shale.
All right, and you got a $45 target on
right.
On Southwestern. You got a buy recommendation.
That's
there.
right.
All right, I want to thank you very much, Nick Pope, coming in from Dahlman Rose, expert in the world of natural gas. We're going to have you back soon to follow what goes on in those Gulf of Mexico production plays for McMoran. Thanks very much.